Have you ever lost money investing into the stock market? Or are you sat in a period of drawdown with unrealized losses plastered all over your investment portfolio? Well, if you have, well, you're certainly not the only one. In actual fact, in these current market conditions, it's probably a little bit more common than you think. Because only 135 of the 500 stocks within the S&P 500 have actually provided a positive return on investment this year, which means 73% of stocks have actually lost money. So the odds are certainly stacked against both me and you guys right now. But how do we turn the odds into our favour? Well, let me explain. But firstly, what I wanted to talk about is one of the main challenges that all investors are facing into right now. And that main challenge is something called the drawdown effect. Let's say you invested £1,800 into Apple stock at $180 per share. But unfortunately for you, the broader macroeconomic conditions didn't play out favourably in the short term. And as a result, Apple's stock price went on to fall to $148 per share, meaning that your initial investment of $1,800 in Apple allowed you to buy 10 shares within the company. However, those 10 shares are now worth just $1,480. The difference between your initial investment versus the current value within your portfolio is your profit, or in this case, your loss. And in this case, more specifically, you'd be sat in a drawdown of $320. The equivalent to 17.8%. And look, 17.8% worth of drawdown might not feel all too bad as an investor, because some of the stocks within the S&P 500 are certainly down a hell of a lot more than that. One of the ones that stands out the most is Netflix, who are down 68.85%. Now, when you sat in these positions of drawdown, you have three main options. You either do nothing and you wait, you sell out and realize your losses, or you double down and you start to buy more. Now, when you're in such a dilemma, greed can start to take over, and that can be the driving force behind some of your investing decisions that may actually go on to hinder your long-term investment performance. You may start to try and take more excessive risk in order to gain back what you've potentially lost. And instead of trying to figure out how you can recover some of the money in a more methodical and calculated manner, some investors end up very quickly in a little bit of a downward spiral. They go on to abandon any kind of risk management, and they end up in an all or nothing kind of scenario where you either win big or lose it all.
I've got nothing left.
Now, the big issue with this approach is that with growing losses within an investment portfolio, it requires exponentially higher returns in order to see a recovery. Let's say a stock is at all-time highs and begins a bit of a drawdown of about 10%, which is also known as a correction. In order for that stock to fully recover, it would actually require returns of just over 11%. Let me explain with an example. If you had an investment portfolio of, let's say, $100,000, a 10% drawdown on that investment portfolio would take you to an investment portfolio value of $90,000. But in order to get back up to that $100,000 investment portfolio, a 10% gain on the portfolio would only get you back to $99,000, which is of course $1,000 short of your starting amount. And therefore, in order to make up the shortfall, you actually need an 11.1% return in order to get that investment portfolio back up to the size of $100,000. Now, this feels fairly negligible, but the bigger the loss, the bigger returns that you're going to need to see in order to fully make a recovery. So let me get a little bit transparent with you guys, because in the past 12 to 18 months, I invested into a couple of stocks which, as of right now, haven't played out all too well. They were admittedly very speculative, very high growth stocks, which to begin with were certainly working out quite well. However, as with investing, things certainly change. And over the past 6 to 8 months or so, we've certainly seen more unfavourable market conditions with the macroeconomic environment towards these types of stocks. And as a result, well, I'm currently sat in a huge amount of drawdown. So let's talk Palantir Technologies as one of the examples. It's a position that I'm down 62% on, which is just over a £1,000 unrealised loss. It's certainly a decent amount of money, or at least it is to me anyway, and that kind of doesn't feel all too great to have that level of drawdown on a position which I've taken. Now, in order for me to recover that 62% drawdown or that unrealised loss of £1,000, Palantir Technologies stock would actually need to go up in value 197%. Now, in order to see that 197% turnaround, which is absolutely huge, then we're going to need to see a hell of a lot of change in the macroeconomic environment, along with a significant uptick in the overall trajectory of Palantir Technologies as a company. Even if you think about the next 5 years as a time horizon, Palantir's stock would need to go up on average at 39% per year just to get me back to break even. So as you guys can see, significant drawdown on a single investment or an investment portfolio more broadly can really hinder the long-term performance of an investment portfolio. So with that in mind, how do you actually try and recover some of the losses within a portfolio? Well, here is a little bit of a blueprint in which I wanted to share with you. Step number 1 is to analyze your investment choices. If your whole portfolio is down 50, 60, or perhaps even 70%, then you're probably going to want to reevaluate the investments which you've made and whether you're actually comfortable with that level of drawdown within your investment portfolio. Because if you're not comfortable, instead you're probably going to want to take a look at some lower risk investments, some lower risk asset classes, some lower risk equities that are going to be able to provide you with a little bit more of a stable return on investment over time. You might want to think about rebuilding your investment portfolio in a way which is more diversified and perhaps working towards an asset allocation which you're going to look to fulfill. So for example, if I take a look at my own personal investment portfolio, my current allocation sits at about 8% in crypto, 37% in diversified funds, 53% in mega cap stocks, and 2% in speculative stocks. I do admittedly need to do a little bit of rebalancing within my own personal investment portfolio after all of the big changes that have happened in the stock market and the crypto market in the past 6 months or so. But hopefully what this does illustrate is that about 90% of my investments are simply held within index fund trackers, along with mega cap stocks too, which certainly give me a little bit more stability within my investment portfolio. And then of course about 10% of the portfolio is left a little bit open towards more speculative investments, but because of that I'm not massively exposed in any kind of way. So what I would say is don't leave your investments to chance and instead work out a little bit more of a methodical plan and an asset allocation that you can work towards in order to properly build out your investment portfolio. Because of course, whilst it's not ideal to be sat in any level of drawdown, it is okay to make mistakes and take some losses when you're investing. Yes, it's a pain in the arse if you lose a few £100 or perhaps even a few £1,000 from a crap investment, but rectifying and learning from those mistakes early on will potentially allow you to make exponentially more money over the course of the long term. Step number 2 is to make some difficult decisions. You might hear some people say, well, you don't lose until you sell. But the truth is, cutting your losses early is sometimes more beneficial to your long-term investment performance. You don't always have to recover your losses from the exact same position that you initially lost out from. Because I'm sure you guys would agree with me, whatever value is left over from the loss that you've taken, let's say £500, you would much rather invest that £500 into a stock or any given asset class that has the potential to make you money over time, rather than the investment that you were in previously that was just continuously reducing in value every single month. So sometimes you've just got to take the L, take it on the chin, learn from the decisions and the actions in which you've taken previously and simply move on. But of course, just be decisive. If you've lost confidence in the investment which you've made, or perhaps you believe the underlying fundamentals of the business have changed, then just simply take action and move on. But just make sure that you don't continuously repeat this cycle where you're continually chasing one stock after the next. Which leads me on to step number 3, which is to regularly analyze your investment portfolio, because you simply can't manage what you can't measure. And what I mean by that is that you need the right tools and the right data in place in order for you to manage better your investment portfolio, to make sure that it's heading in the right direction in terms of the return on investment that you desire. Now, if you're regularly investing into a market index tracker, then perhaps this is a little bit less relevant, because if you've taken a more passive approach to investing, then it's kind of the more set it and forget it type approach. But for those of you guys who are investing into more individual stocks in order to maximize your investment performance, you're going to need to be on top of that investment portfolio in order to ensure that it's delivering the results that you desire. And in essence, the more stocks which you have within that investment portfolio, the more difficult it is to manage. And on top of that, if you're continually seeing losses amongst large holdings within your investment portfolio, but you're not managing them in any way, then things can really start to spiral out of control. So it's important to have proper insight on all of your investments in order to make some tweaks and some changes over time. And hopefully that will allow you to not only minimize your losses over time, but recover from any losses which you've previously made, as well as go on to make a significant return on investment investment over the course of your investing lifetime. And if you do want to get your hands on a tool that will make it easier for you to do that, then be sure to click the link to my investment portfolio tracker down in the description below. Now, to make sure that you don't continue to take losses within the stock market, then you're probably going to want to check out this video here on a stock that provided a 0% return on investment over the past 22 years. And with that being said, I'll see you over in the next one. But before you click on that video, guys, I am raising some money for a charity called Young Lives vs Cancer. I'm doing the 3 Peaks 24-hour challenge in a couple of weeks' time. So if you would like to donate, no matter how big or small, I'm going to leave a link to that down in the description too.